Quick note before we begin the episode. Episode 200 is fast approaching, and to mark the occasion, Hussam and I will host a special Q&A session with questions from you lovely treasurers. Click on the link in the show notes to submit your question, and we will even send a $10 gift card for our favorite 5 questions. It can be about careers, treasury, Corporate Treasury 101, or even what Hussam's favorite ice cream flavor is. Deadline to submit your question is December 15th. Have a lovely episode. Welcome to the Corporate Treasury 101 podcast. This is the first part of our full interview with Matheus Zani, where we discuss restricted currencies and markets in Latin America. In this episode, expect to learn what are restricted currencies to begin with and why do they exist, which currencies in Latin America are considered restricted and what challenges do they pose, how do these currency restrictions impact foreign investment and trade, are there notable trends or shifts in these restrictions that businesses should be aware of? And like always, much more. Latin America is fascinating, really, and especially when it comes to financial risk management and FX risk management activities. And we got to talk with a very expert from the region. We hope you will enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us and help more people learn about treasury. On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101. And with all that being said, please welcome Matheus Zani. Matheus, thank you so much for joining us on the show. Can you maybe start by explaining to us what exactly are restricted currency? What is it and why do they exist?
No, for sure. No, first, thank you for having me here today. It'll be a pleasure to share a bit of my experience with the whole audience. Regarding your question, restricted currencies are foreign currencies subject to government-imposed controls, pretty much. So often to manage capital flows, preserve the foreign exchange reserves of these governments, or this currency can be impacted by the monetary policy of these governments. So pretty much is actions from the government side that can impact the currency value of the currency pair.
So why would the government? That's interesting. Why would the government want to preserve the foreign exchange reserves of its country? Like, what's the interest for them in doing that?
That's a good question. And to answer you, I will give you a couple of examples. Let's use Latin America as the example here because it's the purpose of this interview. No? In LATAM, some of the restricted currencies include the Argentine peso, Venezuelan bolivar, and occasionally the Brazilian real. Okay, I can mention these 3 currencies. And the government of these countries, they use these kind of actions or policies to preserve the foreign exchange reserve, they want to use this to preserve the value of the currency of that country. Okay, most of the time against super depreciation against the dollar. Okay, so or if you look at the inflation side as well, the government uses these policies to try to cap the inflation impacts. A good example of that, Argentina and Venezuela. Argentine peso has limited access to foreign currency, mostly because the hyperinflation. Now, I think we can explore this later in this interview. Argentina has, I think, more than 120% of inflation, which is quite high. And Venezuelan Bolivar is pretty much the same. So both currencies face extreme exchange rate volatility, and the governments, in order to bring down this volatility and also to combat the negative impact of the inflation, they use these actions, they use these policies to manage the currency value of the currency.
Super clear. So if those governments wouldn't be restricting their currencies, they would be a bit open on the market, right? And if any country wants to purchase some of those governments would have to issue more money, leading to easier inflation rates and more volatility. So it's a kind of way to mitigate that. Super interesting. So I think you mentioned 2 or 3 of them without maybe going to all the currencies in Latin America, but typically, what are the big currencies in Latin America? Because indeed, the idea is a bit to focus on this region. Which ones are considered restricted? And then what are the challenges that come with that?
Yeah, as I mentioned, I think on top of my mind, I'd say Argentine peso, Ecuador. Ecuador is slightly difficult because the Ecuador adopted the dollar as official currency in 2000. Exactly in order to stabilize its economy. But I think the hottest currency now that I can say that's completely restricted currency is Argentine peso. Very recently, the Argentine government implemented strict controls on the FX. So in order to companies and business to access this liquidity has been quite difficult. So business that, as you know, Argentina has a very large exporter background, so exporting cereals, cattle, and so on. So in order to this agro business to converting dollars to Argentine pesos is quite difficult. They have limited liquidity, and the opposite is the same as well. For Argentine important companies that want to do the acquisition, to the purchase of some goods, is quite difficult. It's quite difficult because they are not able to convert the Argentine peso to US dollars. So they have some limitations per trade, limitations per week. So it's not fully open. Yeah, you need to respect the regulations of the central bank of the country. I think then currently Brazil real, Mexican peso, Chilean peso, Colombian peso, I think we can say they are off this list. They are much more open in the FX market. You have plenty of liquidity. The central banks, they are very solid entities in those countries. So and they are very pro-business, pro-market. They don't want to put barriers or obstacles in the currency because they know the negative impact that can generate in their economy. So I think for now I would stay with the Argentine peso and the Venezuela bolivar.
So there's when countries have these restricted currencies, how does that affect the foreign investment market? So say I'm a corporate inside a country that has a restricted currency like Argentina or Ecuador. How will that affect the type of investment that I'm likely to get or the trade I can do externally?
That's a good question. I believe the international investor, either family office or other governments or large fund managers, they do a very strict due diligence in that country, the destination of the investment. They need to understand the the regulatory framework of that country. They need to understand the political risks. And right now, more and more, we are seeing that the checkbox of currency is one of let's say one of the most important components when investing overseas in those countries, no? Because first you can have a large depreciation, so you allocate your capital. Let's say let's use Brazil real as a good example. Let's say that you allocate your capital into a 5 reals per dollar now today, but this we know there's a long-term investment. So let's say 10 years, 5 years is a very large horizon to make the gain of the capital and make this investment profitable. But the risk is the currency first, a depreciation of the currency against the dollar. So this BRL can jump from 5 to 7 to 8. So just in this depreciation, you have like a large losses in your investment. Second, in other countries, you can put your capital in the country, but you're not able to remove this, to bring it, to move away of this country. So that's very difficult. There's a very serious implications that all investors must to have in mind. This happens quite often, not in LATAM, but I would say Africa, countries such as Nigeria. We have seen that a lot of businesses are struggling to collect their dividends from the companies in Nigeria, or if they plan to do some exit, they're not able to collect the value of the company that they sold. So there's a lot of implications. So these managers must do a very large due diligence, very serious due diligence to grab the big picture when investing in those countries. And FX risk has been, I think, one top 3 really of the concerns of these international investors allocating in LATAM or in general emerging markets.
So from the corporate side, you need to watch out if you're sitting inside one of these restricted currency zones that foreign investors are less likely to come to you or have all these other considerations just due to the fact that you're operating in a current or in an economy that has that currency, right? What about the other way around? Like for a corporate inside that country that has, that is operating in Argentinian pesos, for example, how does that affect their business operations day to day? Like, I guess locally it's a very different a very different scenario versus internationally. So an Argentinian steak company, because Argentinian beef is super popular, how do they need to, what's different about their business operations versus a US steak company?
They need to be much more sophisticated, much more creative in order to address these implications, the negative implications. As I mentioned, for an importer that need to has a liability in foreign exchange in dollar or in euro, they need to have a very good planning in order to pay this liability. Okay, why? Because tomorrow the government can say, oh no, now have a limit. All companies of this country must have the right only to buy $100,000, but your liability is $1 million. Okay? How will you be able to pay this liability and avoid any kind of default? So must be creative to have like offshore entities set up with some dollar reserves, be able to access offshore liquidity, able to have relationship with different counterparts. This is another way to diversify your treasury, because you'll be able to find liquidity from different counterparts. This is one of the good strategies. But yeah, I'd say in general it's quite difficult. It's quite difficult to be able to address all the negative implications. I'd say that, and also have a very solid team able to run more accuracy cash flows, taking consideration this volatility of the market, not only the currency, but the actions of the central bank. It's not easy at all. It's not easy at all. We haven't seen more and more Argentinian companies trying to escalate their businesses. But in order to escalate their business, first they need to structure some offshore structure to access other markets, and also able to create this bank relationship. But they struggle in the fact that because they're from Argentina, they don't have that high quality of credit. The counterparts run their models in terms of credit, also penalize just because it's Argentina, because they are aware. They are aware of the central bank actions, the government action, mostly in the top of that. So it's quite difficult. It's not easy. It's not like a country like Brazil or Colombia or Mexico, where they are much more open, they are more transparent. The political risk is still there, but it's not elevated as such as in Argentina, Venezuela, and so on. So it's easier to make business when you have this environment of lower currency risk, lower political risk, economic risk, and so on.
Super clear. Is there a general trend that you see going on restricted currencies? Like, is it across LATAM, if we focus there? Is the situation getting quote unquote better or worse in general, or is it just very unique country by country?
It's very unique country by country. Let's say Mexico. Mexico has generally maintained a more stable currency or currency environment, I'd say, over the last years. We have seen that they have an international policy much more open and again pro market, but it's essential to monitor the peso's performance as economic and political events can influence its value. Mexico has a long history of political conflicts. Political agenda is not that clear, so that can have a direct effect on in the value of the Mexican peso. Other example, Chile. Chile is the same thing, very relatively stable, but fluctuations can occur due to the factors like copper prices. So when Mexican is more political, Chilean peso is more related to the commodity. So it's a commodity linked currency that we say here. So if the copper prices it's higher, this can help the Chilean peso. And on the other hand, you see the copper price is lower, the currency can be seen in a position of weakening against the dollar. Peru, the currency of Peru is Peruvian sol. So, sometimes people think it's a Peruvian peso, but it's Peruvian sol. Has experienced some volatility in the past as well. Mainly due to political situation in the country, and it's not that in the past. It's recently in the last 2 years we saw a lot of negative implications due to the political environment. So it's important to business to monitor the political landscape mainly in Peru. Brazil. In the past, I would say it was a restricted currency, but nowadays it isn't. Completely free floating. But of course, still have some influence by the political economic factors. I would say that the second one, the economic factors, is a huge one. Okay, so government interventions, along with economic development, they have the power to stabilize the currency or do the opposite, to increase the volatility of the Brazilian real over the time. Ecuador, as I mentioned previously, Ecuador adopted the dollar as its official currency in 2000 to stabilize its economy. We have a similar discussion right now for Argentina as well. if I'm not mistaken, the opposition right now, because we have presidential elections coming, they are discussing how to adopt dollar as the main currency in the country. They have, of course, they have a lot of theory, experiencing behind of this proposal. Mainly because when you start using dollar, you may be able to address the high inflation. Because in Ecuador, Ecuador was very successful adopting the dollar because we were able to reduce the inflation, but it's not true at all the times. Okay, so yeah, I'd say each country has your unique challenges, your unique policies regarding the currency.
Looking at it a bit from a corporate treasury and global standpoint, one of the challenges I see with those restricted currencies, and where it's particularly impactful for treasurers, is when it comes to credit lines of any sort, right? Because especially big organizations who are often looking for a global banking partner for the whole region with one big revolving credit facility, for instance. In Latin America, the challenge is that you need to look at each country individually, but also what are the capacities of the country and the bank itself when it comes to credits, because some banks might not be able to provide you as a company with as much credit as you want, not because you don't have the right credit rating, but just because the currency is so restricted that they cannot issue such a big credit line. So it's an interesting challenge to tackle when you're in corporate treasury. And also the interest rates vary, right, between each country, making the whole credit part of an organization wanting to do business in LATAM much more intricate, which is super interesting. So yeah, sorry, what's your opinion on this, Matheus?
No, you're completely right. Mainly in the interest rate. Right now we are in a period of, I'd say, almost all Latin countries are suffering with inflation, high inflation, and to address that, all the central banks start to hike rates. So as a result, we have increased borrowing costs, which from the corporate side, they face a lot of challenges regarding how they can restructure their debt with a cheaper cost, but it's very difficult in such environments of high interest rates. One alternative to that in the past was to issue foreign debt, mainly from USD like that, but now it's also expensive offshore. You have Fed rates around 5.50, and in Europe more or less the same situation. So has been a very challenging market environment right now for those that depends on credit, either domestic or offshore credits.